Morning, everybody. Nick Davis with Team Davis, Remax Premier Group, and here with Kyle Edwards with Iberiabank. We'd like to give you an update on the Tampa Bay market.
Very good. Appreciate Nick you having me. Appreciate Team Davis and all that they do. Yeah, Nick asked me to come in and just kind of give an update on what the market's doing in our local Tampa Bay market and really what interest rates are doing. From an economy standpoint, of course, y'all have heard a lot in the news, so I just wanted to kind of give you an idea of what's going on in the market, where interest rates are, where they're going, where they've been, that type of thing. Starting off last year, 2018 certainly saw its share of interesting real estate ups and downs with sellers benefiting the most. Home prices were quite high, interest rates were low, and last year was definitely a seller's market. But 2019, I think we're obviously well within the third quarter of 2019. We've obviously experienced a shift, and I think that's going to continue. And the tides are turning towards a buyer's market. In our local Tampa Bay market, there's definitely a shortage of homes. Wouldn't you agree with that? I mean, there's definitely a shortage of homes in our market.
Absolutely. The houses that we're seeing that are staying on the market for a long period of time, typically when you do the research and you look at the houses, they're overpriced.
Yeah, absolutely. Yeah.
They're overpriced, and there's sellers that just think that we're in '05, '06,
Yeah,
'07.
exactly.
And sometimes it's hard to sit with them and tell them, well, this is 2019.
Right, right.
We definitely, I think right now our current inventory is just under 3 months.
3 months, yeah.
So it's hard to find, especially the first-time home buyer homes.
Yeah, exactly, and that's what I was going to mention too, specifically at those entry level prices. So, that's a lot of folks call me each and every day asking about wanting to get pre-approved, looking for a home in the 150 range, and there's just not much out there. So, and many experts agree that low inventory is an issue, and that will continue into 2020. So for your move uppers. Who bought at that $180,000, $200,000 price range a few years ago. It's now a great time to capitalize on that and sell and invest that equity into a larger home. We now, we're seeing from an interest rate environment, we're seeing rates in the, sub 4%. Last year, towards the end of the year, they'd gotten up to 5%, in some cases a little bit higher. Yeah.
How does that affect the buyer? With
Oh
regards
yeah,
to
absolutely.
the interest rate, to
Yeah.
say, at 5%, this is what you were looking at versus now in the below fours.
Right, exactly. So if you're looking at a full percentage point spread, I mean, you're talking probably about forty to $50,000 in purchasing power. So it's pretty significant, and it really depends on taxes and insurance have a play on that. So
Absolutely.
the higher the price home, the higher the taxes and insurance are going to be typically. But it's a pretty big spread there. So that can make a big difference. So again, this past week, just kind of talking about something that's just within the last week or two. We watched home loan rates touch 3-year lows as investors around the globe continue to seek the safe haven of the U.S. dollar. So why are global investors moving money into the U.S. dollar and the safe instruments like U.S. bonds? And keep in mind that when I'm talking about bonds and stocks, that obviously has a big bearing on interest rates. The markets, they compete for the same dollar. So if you see the stock market doing pretty well, typically the bond market's deteriorating. So mortgage-backed securities are directly linked to the U.S. bonds. So due to lingering uncertainty, and this is why some of the reasons why global investors are moving their money into the U.S. dollar, lingering uncertainty behind the U.S.-China trade disputes. Y'all have probably all heard of that going on. Global economies are slowing, and central banks around the globe are cutting interest rates. So all of this forces investors to search for a yield in a world where many countries like Japan, Germany, Switzerland, and the like have negative interest rates. Believe it or not, meaning investors who park their money in those countries receive no interest and a loss on their principal. So that's a bad investment. That's why we're seeing what we're seeing in the markets right now. So we all know rates are low. They have been for the last 12 years or so, but even lower over the last 3 months. So if you've been watching the news, obviously the Fed cut short-term lending rates for the first time in over a decade at the end of last month. And that's more or less like a preemptive move aimed at extending the already record-long economic expansion. So Fed cuts, what they do, the whole point of that, it helps stocks. It promotes inflation and economic growth and confidence. These are all negative for long-term bonds, like mortgage bonds. So the purpose of these Fed cuts is to keep the economy growing, help stocks, create inflation, which again is bad for the bond market. So that typically goes against long-term interest rates. So, I got a lot of calls last week and even up, probably within 3 weeks, hearing about the Fed's going to cut rates, and hey, that means rates are going to drop 0.25%. And no, that's not the case. That affects short-term lending. And again, it's typically Fed cuts are negative to long-term bonds, but those Fed cuts were already kind of built in or baked into the markets. So we had already seen, 3 months ago when rates dropped, investors were planning on or assuming that the Fed was going to cut rates. So that was already built into the market. So again, get a lot of calls on that, but that's kind of how that works. So the outlook in general for the U.S. economy remains favorable. And the action is designed to support the outlook. Federman Chairman Jerome Powell said inflation is low and rate cuts are an insurance policy against potential speed bumps for the economy, including, go ahead. Yeah, sure, absolutely.
Because I know a lot of people out there probably have heard the dreaded R word. Recession.
Yeah, you're jumping ahead of me, Rick, and I'm about to discuss that a bit. But
it's so funny that when bad news or bad words create such a spark.
They do
in the industry, because everybody wants to jump on the bad news train. And doom and gloom is ahead. You got to do this now.
Right.
Otherwise, you're going to miss out.
Right.
And I know, Cindy and I, not only recommend Kyle. We've used Kyle to purchase our home. Our sons used him to purchase his home. My brother-in-law's used him to purchase his home. My son's fiance's used him to purchase her home. So I don't just believe in him. I use him personally. So I saw everything that I was seeing on Facebook about, stick your zip code in here and refinance your VA loan. And it was the
IRLA, interest rate reduction loan. Yeah, IRLA.
And so I put my information in, and the next thing it was like, okay, give me your email address and your phone number. And I was like, oh, stop. And I was like, okay.
Yeah.
813-495-5131.
Yeah.
Kyle.
Yeah.
So I called Kyle, and he's like, just, and kind of walked me through it and said, not yet, but we're going to keep an eye on it. So it's not just what we're doing today, but, being able to forecast and see. And that word recession just blows everybody out of the water. Everybody wants to jump over onto the other side of the boat.
Right, they do.
And then the boat starts to tip that way.
Exactly. So, anything that's mentioned in terms of, and we're going to talk about this inverted yield curve, and that's kind of my next thing that I'm going to address. But you're right.
Sorry.
That's all good. It's all good. So yeah, you're right. When people hear recession, they start to clam up. They start to tighten their pockets, and they're like, oh, maybe I shouldn't move, or maybe I shouldn't buy a house right now, or maybe I shouldn't do a cash out refinance to improve my property, or those types of things. But that's just part of the economy. Recessions come and go, and again, I don't want to say too much. I'm going to talk about that in a minute. But you're absolutely right. That's people tend to grab onto those negative headlines. And and that's what they tend to focus on. But you gotta see the forest through the trees type of thing.
Absolutely.
So kind of going back to the overall economic outlook. Like I said, inflation is low. Rate cuts are an insurance policy against potential speed bumps in the economy, including rise in trade tensions and a slowdown in global growth, which obviously is a concern. In global markets, there is already, in some cases, negative interest rates, as I mentioned before. in the U.S., I love this analogy. I've heard it many times. We're actually the cleanest shirt in a pile of dirty laundry when you're talking about global markets. So, and from an economy standpoint, and the Fed wants to keep it that way. So further rate cuts are probable. Okay, wow. And like I said, with further rate cuts, again, as I'd mentioned, it's typically negative against the bond market. But we're going to talk about here in just a second how I don't think that is actually going to be negative in terms of the bond market, in terms of interest rates in general. So, President Trump, he's been pressing the Fed to lower rates as fears rise that growth could slow. We've been booming the last couple years. The central bank's benchmark already is super low, currently targeted between 2 and 2.25%, with prime rate coming in at 3%, which makes the prime coming in 3% above at 5.25%, which is actually prime rate right now. But the Fed may not have enough firepower to actually prevent this recession. Wow. And it might not be a bad thing, but again, we're going to talk about that a little bit. So yesterday, U.S. stocks rallied at the start of Monday and throughout Monday, lifted by encouraging comments by President Trump and other officials on trade talks, along with a move by China over the weekend. So the news is ever changing. In terms of looking at 2 weeks ago till today, everything has changed. For the most part. So, of course, Nick mentioned recession, that R word. Of course, people get nervous when you mention recession, and basically all a recession is, it's a period of temporary decline during which trade and industrial activity are reduced. And the 10-year Treasury yield, it briefly broke below the 2-year rate on Wednesday of last week, and that's what we call, and I mentioned before, an inverted yield curve. Have you ever heard of that before?
Honestly, no.
No idea what that means. So I'll try to put it in layman's terms. So, an inverted yield curve, and this is pretty telling. It basically flashes a recession warning, and that sends stocks tumbling last week. And as of Friday, the curve steepened, and it was no longer inverted. So it happened very, very temporarily for about maybe a half a day, and then it got away from that inverted curve. So here's why the yield curve inversion could lead to the lowest mortgage rates we've probably ever seen.
And that would be a good thing.
That would be a good thing. So, and again, that's not to say it's going to happen, but it very well could. And I'm going to tell you some of the reasons why.
So let me ask you a question. Mm-hmm. With saying that, a lot of people say, well, why should I do something today?
Yep.
Opposed to wait? Well, I can tell you that, in 1989, when Cindy and I bought our first home,
yeah,
the interest rate was 11.5%, 12%.
Exactly.
And that was prime.
Right.
And then the market started coming down, and we had an FHA mortgage, which we could refinance every 6 months if the interest rate was lower, and we would just basically do rate refis.
Sure,
all
yeah,
the way down.
yeah.
No
Streamline
cash
refis,
out.
yeah.
No cash out, no nothing, just change our payment.
Right.
And in the time that we owned that house, as we did the refis, our mortgage went from 11.5% down to, I think it was like 7.5 or 8, which that's where prime was.
Yep.
So it's still something that, even if you look at your credit cards, the debts you do carry, 4-5% interest rate,
yeah,
is probably the cheapest rate that you have on any borrowed money.
Right, exactly.
So, when people say, "Oh, I'm waiting for 3%," well, we may not see 3%.
We may not see it yet.
But for 3.25%, 3.75%, those are all still good rates.
Absolutely.
On lending money.
They are. And don't let that, with what I'm going to talk about right now, in terms of rates might be the lowest that we've ever seen in history. That could happen, but there very well could. Anything could happen. A tweet could change that. So I mean, don't let that deter you from buying something, because, like I said, the market right now is prime. If you want to sell, move up, take advantage of that equity. Purchase something now. I mean, rates are sub 4%, and if rates do drop, you can always refinance. If you're going to save yourself 2%, on your mortgage, if rates are 2%, a year and a half from now, it's worth
That's
paying.
kind of what we're doing.
Yeah, exactly.
We're kind of playing, because when we purchased our home in 2017, I want to say that on the note, the interest rate was like 3.62%.
Right.
And so that's kind of what kind of sparked me. Was I was hearing all about this, 3.25%, 3%.
Yeah.
And you had said, well, let's kind of just wait and see what happens, because, in the short term, if you're just going to turn around and sell, like within the next year or two,
Yep.
it may not be a good thing.
Right.
To do. It may be better just to stay where you're at, because there are costs associated with
Sure.
the refinance.
Exactly.
But if you're going to be in your house 5, 7, 8, 9 years, it may not, may be a good thing to do. And that's kind of where we're looking at, is that, we plan on staying in our house, for a while, a good while probably. So we're watching that rate and seeing how it does affect us, because, when you start saying, $70, $80 a month,
Yeah.
and you say over the course of a year, it's $1,000.
Right, exactly.
That I'm not paying to the mortgage, that's
Right.
going back into my pocket. So all of that said, even at 3.75, 4.25%.
Yeah. It's a good rate. It's a good time. It's a good time.
Really
Yeah.
is.
And don't let, like I said, even though rates might tick down, and that's a possibility over the next, year and a half, something like that. Those home prices are going to be higher. So, if you purchase now, then refinance down the road.
Exactly.
Don't wait to purchase a home just because you think rates are going to drop. But there's no guarantee of that.
Well, if interest rates drop, let's just use 0.5%.
Yeah.
But here in the Tampa Bay area,
Right.
on an average,
Yeah.
we're seeing between 4 and 6% appreciation
Exactly.
in homes.
Right.
Some areas lower, some areas higher.
Right.
So to save 0.5 or 1/4%, but the value goes up
Right.
5%.
It's going to wash it out.
Right.
Yeah, it's
You
going to
might
wash
buy
it out.
less.
Right.
Be able to-
Exactly.
or be able to buy less.
Right.
I should say.
Exactly. They're all very, very good points. So, kind of getting back to the whole inverted yield curve.
Mm-hmm.
So I'll kind of explain that. And let me just kind of preface this by just reading a couple things here. So, the spread between two key interest rates, like I said, inverted Wednesday the 14th, August 14th. And here's why that seemingly insignificant phenomenon could lead to ultra low mortgage rates, as mentioned. And mortgage rates have been dropping fiercely. So many rate shoppers assume that they can't go any lower, but they could be wrong. Quite frankly, the U.S. economy is in uncharted territory, the conditions of which could spell the lowest mortgage rates that we've probably ever seen. And again, it's a possibility. So what's the big deal about this inverted yield curve? So in short, a yield curve inversion is a big deal because it's awfully good at predicting oncoming recessions. So in fact, it's accurately predicted the last 7 recessions. And with recessions typically come very low interest rates. So in a normal world, a 10-year U.S. Treasury, or what we call as a T-bond, will pay investors more than a 2-year bond would. It's just like a CD. So if you take your money, you take it to your bank, and you say, look, I don't really need this money now. I want to try to get a pretty good rate of return. If you put it in, let's just say a 5-year certificate of deposit, a CD, and you might get back, 5%. But if you put it in for maybe just a 1-year CD, it's going to pay you a lower interest rate.
Absolutely.
So this inverted yield curve, basically what happened is that the interest, the rate of return was paying higher on a 2-year T-bond than it was a 10-year T-bond. So that goes against the normal common sense thinking. So that's why, like I said, investors said, I don't want to invest in a 10-year T-bond because I think interest rates are going to be lower. And that's why it's always predicted the last 7 recessions.
Wow.
Okay, so it's one of those phenomenons that we've really only seen 7 times because we've only really had 7 major recessions since we've been tracking that. So anyway, a yield curve inversion is when, in short, bonds pay more than long-term ones do, like I had mentioned. So basically, the 2-year note pays more than a 10-year note. This has happened prior to every recession in recent memory. But why would a short-term bond pay more? Okay, and I just mentioned this as well. Markets believe that the government will soon intervene and bring long-term rates down via stimulus.
Wow.
No one wants to commit to a 10-year bond when things are so uncertain.
Yep.
And this brief but significant inversion happened, like I said, last week, Wednesday. So rates are the lowest they've ever been when recession fears hit. So right now, rates are the lowest they've ever been before a recession. And again, I'm not stating that there's going to be a recession, but again, this inverted yield curve, it could be just a fluke, a mishap. It could very well be. But the rates are the lowest they've ever have been. So you typically before a recession, rates have been much higher. So what happens to mortgage rates after a yield curve inversion? They drop about half of where they were at pre-recession levels. So again, that's hard to imagine. Now I've already mentioned it already. Rates are at 3.75-ish, give or take. So if they drop half, we're talking sub 2%.
Sub 2%.
I mean, that's unbelievable, right? It really is. But we're in a global market. So let's look at it from a global market standpoint. So that seems unlikely, obviously, in today's world. But keep in mind, there's a Danish bank is already offering negative mortgage interest rates, believe it or not. And former Fed Chief Alan Greenspan says there's no barrier for U.S. Treasury yields going below zero. So U.S. Treasuries don't dictate mortgage rates, but rates often follow the same trends. If Treasuries go negative, we could realistically see 2% rates or lower, possibly. So unsure about this prediction. Obviously, I have I have my doubts. Obviously, I've been in this business for 17 years. When I first got in the business, rates were at 7%. When they dipped, and when they got into the 6%, it was a refinance boom. And rates have been so low for so long, so it's hard to even imagine that they could go any lower. Really, no one knows what's going to happen. The inverted yield curve could just be, like I said, a false alarm. But after all, each history doesn't always repeat itself. If you're in the no recession camp, which a lot of economists and folks that are a lot smarter than myself are, you could capitalize on rates that are already lower than anyone thought that they would be now. You can do that now.
Well, I remember back, everyone was talking about 4%. 4% was the number.
That was,
and that was the magic number. Let's reduce the rate to 4%. And then we saw 4%. We saw mid threes. And everything. So again, when you look at your money that you're borrowing versus the interest rate, there's no cheaper money to borrow than
there's
not. Home purchase.
There's not, and there's no use sitting on the sidelines and just waiting. It's take advantage now. It's a great time to purchase. It's a great time to refinance. Could rates drop? Like I mentioned, could they drop to 2%? They very well could. We just don't know.
But they could also go up.
They could also very well go up. They very well could. If the economy continues to boom like it is,
right.
And it's this with the Fed cutting, they could get more aggressive.
Yes.
And they could rates that could continue our economic boom. And if stocks rally and the Dow continues to go, we could very well see interest rates hike up again.
Yeah.
So anything can happen. Like I said, we don't have a crystal ball, but at the same time, don't let the forecast or the predictions sway your decision on what you're going to do. For us in the mortgage and the real estate industry, we must understand the volatility. It's high.
Change is evident.
And what do they say? The only thing that's for certain is change. Right? Yeah, exactly.
Absolutely.
So like I mentioned before, volatility is high, and a glimpse of good news or even a random tweet could change sentiment very quickly to something more positive, which would be bad for bonds and interest rates. So here's the deal. Like I said before, we can always predict and forecast, but the bottom line is, unemployment is low. Jobless claims are at 49-year low. We got a strong job market, especially in our local area. Mm-hmm. There's over 900 people moving to Florida daily. So that's 330,000 people per year annually. Interest rates are low. Home appreciation this year will be more historical levels, like you said, 3 to 6%. So buy now. What I tell you, buy now. Take advantage of where prices are, and then refinance later if you want to. So don't let that deter you from actually getting into the real estate market.
Right. Don't
So,
get priced out or
Yep.
have to settle for less
exactly.
because the appreciation, the market has increased more than the rate has, the mortgage rate, interest rate has reduced.
Exactly, exactly. And it's all supply and demand too. And keep in mind that if rates do drop, then more than likely home prices are going to stagnate,
Yeah.
typically. But at the same time, folks can afford more. So when rates do drop, like I'd mentioned before, but the thing is, it's uncertain. We just don't know. But hopefully, this gives you guys a pretty good idea of what could happen, the forecast, what the economists are saying, and like I said, folks are a lot smarter than me. But anyway.
And what I'm going to do is I'm going to put Kyle's contact information on here so you can reach out to him. And again, like I said, I don't just recommend him. I've used him personally. My family's used him. And I've met a lot of mortgage people and through my years, through my nearly 15 years.
Yeah.
And I can tell you that I want to say that we've been working together almost 9 years.
Yep.
Since like 2009.
Yep.
And so in the first 4 years, I think I went through 5 or 6 mortgage people.
Yeah.
Then started working with Kyle, and if I have my choice, I would say call Kyle because 1, I know his ethics. 2, I know that he's not going to tell you something that you can't do.
Right.
And 3, I don't think we've ever not closed
We have
a loan
We've-
that we started.
Nope. We've closed every single one. There's never been a time that that a loan hasn't closed. There's might have been one that was delayed. I remember maybe 6 years ago, but hey, one out of
Delayed.
Yeah, delayed a bit. But one out of it's been a lot. I would say
Couple
probably,
hundred.
Yeah, I would say a couple hundred.
Easily.
But anyway, well, I appreciate you so much, Nick.
All
Thank
right,
you for
Kyle.
having me, and thank you all. And like I said, please call me if you have any questions. I'll be happy to help any way I can.
And again, I'm going to put Kyle's contact information down in the description for you as well, with a link to his website.
Yep.
And if you need anything here in the Tampa Bay area, Cindy, Nicholas, and myself are just a call or click in the box, a wave, and we'll get ready to go to work for you.
Thank you so much.